Hello, Warriors. Kevin, how are you? Ren, I notice a new name here. Ivelisse, nice to meet you. Didier, Brock, Monty, Jeff. Okay, so this is a channel I see. How are you, Hugo, in S&Ps? It stretches almost to the 78.6 level, depending upon when it gets here, if it gets here. So this is what I'm working off of. You're already in there, 34.40. Okay. Yeah, I see it almost right to the number. That was a great call, Jess. There's just one problem why I won't do it right here. Charts aren't showing.
Yeah, we can see the, there you go.
How's that? Okay,
That's
so
good.
here's the,
Morning.
thank you. Thank you, bro. I'm Mr. Not low tech, Mr. No tech. Anyway. You think Blake's the only one that has mobile phones that are Dixie cups and string? Yeah, me too. So, okay. So anyway, this is a channel that we're getting here, and Jess already sold it. Oh, here's my problem with it, at least for today, is this right here. I mean, I know it's a short TF, but you know, an 80 reading up here. So actually, I'd be looking for another high. There are some people talking 34.75, 34.80, which is, you know, close to 78.6 here. But, you know, I don't think there's anything wrong with a scale in. You know, what I try to do now that I don't go all in at one price. So let me ask you, Jess, where are you wrong on the trade? What do you risk from 40? If you want to share it. Okay. So when you say that, it tells me that the likelihood of, you know, 40 not being it. So the point is, if you just put a piece on at 40 and you still believe in the trade, if it gets to 80, you put on another piece, right? Because, you know, when you go all in with everything and, unless you really reduce leverage and you can withstand that type of stop, 32.80. Okay. How do I get in your hedge fund? Anyway, we'll see if it's today. If I look around for a reason of why it could possibly happen from here, would be the dollar. Remember, the dollar turned first before we got the first break. Hello, Monica. And, you know, it held where it had to this week so far, above the 50% retrace. And then it rallied up to this 387 level. And to me, this looks like this could just be, you know, 1, 2, and we're ready to come out of here. And if the dollar does come out of here, I think that we're then close to a top, and Jess already has a lead. So that's the S&Ps. Just want to let people know, if you took Aussie Kiwi down here on Tuesday, you know, should be booking at least a piece up here. I know it measures more. I actually think, you know, that we'll take out this high. I don't think this was it, even though we could correct here. I think we have to stay over 840, 850, because that was one of the premises, is that we had some type of breakout right here. Let me move you guys. That this was a neckline. So the falling wedge developed into a head and shoulders, and it's a 150 point formation, which would take you closer to the 110 level. Okay. Dixie to go up, break above confirmed high. Where's the confirmed high and what time frame? This right here on the 4 hour. you have to give me TFs because, you know, RSI is going to look different on different TFs. Yeah, I still think the dollar is going higher. In fact, you know, I've been talking for a few weeks that, you know, why can't we get back to the breakdown, which was, you know, 95.5 or so. Okay, so, you know, this is what I'm looking for up here. After this 3 drive to a bottom, I could even make a case for 96, 97. Here's the moving average on the daily, the 200's coming in at 96.87. I wanted to go through just the euro pound, which is so choppy. And, you know, I'm bullish looking for new highs. I just want to show you why. And where I think it could go, which I don't think a lot of people are thinking that can happen. And I know Stell wants to be a seller in this. So let's see if the monthly shows it. Okay. So see this all the way back here was a big confirmed high right here. I think we're going to be taking that out. And if I just go to a weekly, all right, I don't need a monthly. Here's Stell. This is what I was thinking of. On the weekly here, we have 1 confirmed. Then we had a higher high on this spike, diverged. And so there's 2 drives. And I think we measure above this high for a 3rd drive, even off this flag here. So I'm looking for over 95 in euro pound. And I think it's going to be driven by the pound having a lot of problems, okay? And being weaker, probably, yeah. You know, I think that's going to be it. This is not a confirmed high. Okay. Anyway, to me, it looks incomplete. A 1, 2, 3. So I'm looking for this 2020 high to be taken out eventually. I'm wrong under, you know, on a macro picture. I guess you'd have to say under these moving average, call it 88. You know, so that's about 300 points. Probably be wrong sooner, but to me, this still looks like a flagpole that we're going to come out of, and I think we could get above here. So that's just my technical view. I have no idea about the fundamentals that would drive it. I just wanted to show that. And I already showed Aussie Kiwi. So this looks like we could get a 3 here as well at new highs. So this measured above 110 or so. So I think that's going on. And I'm not impressed with the gold recovery. And, you know, give me a rally back to 1900 or so, and I'll try it. You know, bulls could still make a case that this is, you know, just a pullback to buy. I'm still thinking we're going to go to new lows. And again, the premise is based upon at the lows, we really weren't diverging. And silver actually, let me go to a 4-hour. See this? Yeah. So I think we're going to take that low out. Silver, even a worse RSI picture at the lows. I mean, look at this, 12. So I think guys that want to buy it under 22 are going to have a chance. I could be wrong. TLT, the bonds still look lousy. And Peter Bookfire is going to be here. I want to ask him one question. Why are the sovereigns, and I bet Steve can answer this fundamentally, why are the sovereigns, and, you know, let's call this, you know, it's an ETF on treasuries, right? Look at this. See, just hanging on by a thread. Why are they weaker than high yield? See that? And treasuries are weaker than corporates. So what has the Fed done? sacrificed sovereign debt with their actions in high yield and corporate? I don't know. Anyway, it's Danielle answered this at the summit, Charles. What did she say? Supply? Supply. Yeah, I wouldn't doubt it. I think Danielle has answers for everything. Daily time frame, it still looks good. Greg is looking for 107. Okay, so I'll do it because I know most of the guys don't like it, even though Blake's going to include it in his chart. So this is the way I saw it. I think the yen is, good, but the first stopping point was, look at this formation, right? It held the breakout at 490. I'm getting rid of you guys for a minute. I'll move you over here. Okay. So you had this first move here from 104, 180. You had the pullback to the breakout. So 180 be 280, 108. Okay. So that's what I think. And weekly, it could turn into something, pretty powerful because I think yields, even though they'll pull back now and then, if I'm right about yields, 10-year going to 120, I think that implies a lot more upside in US dollar yen and more downside in metals. But we're getting a little pullback here today, but this is just starting. All right, we're just on the verge. We need closes over 80 on the 10-year. And you could tell, we're approaching, these are weekly numbers, the weekly 50. So, why can't the 30-year yield over 2 or more? Okay, so that would be bullish or supportive on the correlation of US dollar yen. Jess thinks 170. Okay, well, that could give you 110, 112 yen, I think, at least. Did that help you, Sanse? And Usman? Okay. I'm bringing Blake in. How are you, bro?
Hey, good morning.
Good morning, buddy.
I'm a little irritated this morning. So, how are you?
What's up?
I was long the dollar Canadian, and then I got stopped out at the neckline here, and I'm kind of thinking I might have got stopped out prematurely, or just like stopped out enough to irritate me. So this is the the head and shoulder pattern, which the dollar Canadian, just so you guys know, I did really well with it last quarter, and it was more of like the last month. I did really well with it as picking it up down here at the 131 level, trading it long all the way through here. I lightened up, and I was hoping to stay long and hoping that we would get a move back above this 3350. And it's just kind of pushed back below the neckline slightly today, and I'm wondering if it did it just enough to stop me out. And it's going to be interesting to see where we close today. I'll be watching for a move back above the 132.60, because if it does that, then I'll just be thinking that it did indeed stop me out, and I'll have to start targeting it back to the long side again. But it's one of those things that I'm a firm believer in this in a lot of my longer term positions, because what I do is I adjust my stops to points. Like the dollar Canadian, for example, was basically to protect my profits that I've had, and I didn't want to give up too much of my previous profits. So I moved up my stop to basically where my break even on my whole other side of the trade was, which is fine. The problem is I feel that, you know, a lot of times when that happens, it's right. The market seeks those areas and then we reverse. And that might've been the case today. I'm not 100% sure, but that's where I'm at. So now it's you know, when you get to that point, Coach, where you're like,
Yeah.
okay, what do I do now? You know what I mean? I don't know if I really want to get back in right now. I probably need a little bit more confirmation, but still it's like, you know, I kind of feel it, you know, when you feel it.
Yeah. Then go in smaller than you were before to have a piece on.
Yeah, I've thought about it. I might later today. It just kind of
Yeah.
depends where we end at, and you
I
know
mean,
what things are.
that's what I do. So if I feel like, you know, I was right, still right the market, wrong the trade, and I know it's going to really piss me off if it starts to work. If at least I have a little piece on after getting stopped out, I feel okay. And then if I was wrong to re-enter, I don't lose as much money, but at least I know I took the action, and instead of being completely risk averse.
Yeah,
Just, you know, it's all in our heads, man. It's all, you know, psychology, isn't it?
it is, and it's like at this point, it's like, man, do I, you know, where are we going to be at, and what am I, you know, it's
I know.
I've just got to assess the situation, especially as we get into the North American trading day. And that's basically what it comes down to. Other than that, the market's been really pretty quiet. I mean, the euro is just kind of bouncing around in a pretty tight range. Remember, we're still trading below the 118 level, which I think is key. You know, the cable's below 130, but above 128. So it's just, you know, again, it's in that bouncing around, not really sure what the hell it's doing type of situation. The Aussie and the Kiwi have actually had some pretty big bounces back. And what's interesting about the Kiwi is that the RBNZ was talking last night about negative interest rates. And the Kiwi came under pressure, but then bounced back with, I don't even know why the hell it bounced back. I guess with risk appetite, I guess. You know, stocks went up and, you know, Kiwi bounced back, I guess. I have no idea. This is one of those markets, you know, Coach.
I'm just laughing at what Ziggy said. Ziggy said, he's reading my new book, Trading on the Couch. You know, that's what everyone thinks. Everyone thinks I'm kind of slothy. Do you think so, man?
I wouldn't say
I'm
slothy.
I'm sitting up, Zig.
Are you? Yeah, you're not.
I'm in a
slothy.
chair. I don't trade from a couch. I do other things, sir.
Yeah. You tell them.
I watch TV.
All right. There you go. All right. So let's. You know what? I'm going to start the analysis process. And by the way, equities. We are pushing that the 618 retracement, and I mean, you know, hey, we may end up grinding higher here. We're so headline driven. By the way, if you watched the debates yesterday,
I did.
Did you watch them? Did you see the fly? I mean, seriously, I can't. I don't even remember what was talked about after the fly situation. I was like so fixated on the fly. I was like, what the? It was like the craziest looking thing. I was like, man, that it's like, you know, somebody tweeted a thing, Westworld, this show on HBO, and there's this famous scene with the girl. She's got a fly in her eye, and it's, you know, because she's a robot or whatever, and it's like crawling around on her face and in her eyeball, you know, and her eyes are still open, and that somebody tweeted that, and it was funny because I was totally thinking that too. But anyway, see, that's the problem, is that I missed like half of the debate because I was like so fixated on this fly and couldn't get it out of my mind. So it was interesting. But it didn't move the markets. Let's just, you know, I don't think it moved the needle. And one of the things that you could argue that the S&P, and what's really interesting is the S&P continues to rally, and people will point at the the fact that the Biden lead continues to strengthen, or continues to hold, and maybe that's one of the catalysts that's kept bid the markets, is because from what I'm reading, that the debates last night didn't make a dent in any of the polls. So whatever you want to say is driving the market, I mean, your argument's probably just as good as mine. So the 618 retracement in the S&P is going to come in at 34.43. I'm going to take a look at what the spike high right here is. Spike high here is 34.48. So I'm going to write down 34.50 as being resistance. We're still in a range. Support right now. I mean, this is probably what we're doing, right? I mean, I'd have to imagine this is it.
Yeah.
Annoying.
Yeah.
Ascending channel, right? Just, you think you got it nailed and you're getting long, and then all of a sudden the bottom falls out. We drop down towards support. We're like, what the hell just happened? Doesn't that make sense? It does to me. 33.65, I think, is going to be support.
And NASDAQ's so much weaker still, Blake, and that's what led it. So.
It is. There's a lot of fluff coming out of the NASDAQ, and one of the things that I think we have to pay pretty close attention on NASDAQ is, we come closer to the election, if the Biden lead stays strong, I think the risk is that some of these tech giants are at risk of getting hit pretty hard, from a monopoly standpoint. So that is going to be a bigger risk for the technology shares moving forward, in my opinion.
When I look at that right now, Blake, it looked like a Head and Shoulders bottom.
I had somebody else talk about this being a head and shoulder pattern, and I'm going to be very clear here. This was yesterday on the daily roundup, and I'm gonna say this, and I'm gonna get it out of the way. And this is my rant for the day.
Okay.
A head and shoulder pattern, or an inverted head and shoulder pattern, is a reversal pattern. It is not a continuation pattern. So probably one of my biggest pet peeves is when people trade these as
continuation
a continuation. Now, I'm not saying that it won't work out, because you could it possibly could, but I will tell you, in my near 5 years of experience of looking at charts, is that if you target this, if you target here, there's a very low likelihood that your target will ever be reached. It's already tough to get an inverted head and shoulder pattern or a head and shoulder pattern to reach its target as it is, but for it to get to reach its target on a continuation is damn near impossible. It does happen, obviously things happen, but I'm just saying that's why I never look at it as such.
Yeah, you're not a fan of it being a continuation.
I'm not, and people try to point it out all the time, and I'm like, well, you go ahead and trade it. Good luck.
Yeah,
that's my 2 cents. Good luck with that.
You're
all right. Let's get the charts out of the way.
Okay,
so the euro continues to hold 118. Support right now is 117.20, and that's it. That's all you need to know. And I don't think you can turn even back into a range until you break back above 118.10. So in other words, that's key, right? Cable. I am going to put it in range, 130, 128, right? And then 127 below that. So I don't think we have to deal with that today. 128, 130. Have fun. You guys have fun trading that one. Aussie. So the Aussie, double top. I mean, it didn't quite reach its, you know, its expected move there. You know, instead we hit, you know, about the 50%, I guess. It's just really sloppy. The markets are sloppy in general, I want to say. But where do I find resistance today? I mean, I guess we just have to look at 72 cents, right? I mean, I guess. I suppose, you know, I guess. I mean, we might have some resistance right where we're at 71.70, but I would just look at 72 cents and then this is 71 cents and kind of call it a day, because I'd be more comfortable just looking for something to develop rather than, you know, you probably have to just look at it as a range. Okay. And we are still bearish while we're below this channel. I want to, well, you know what? I should probably just keep it on range right now. We have to we turn bearish below 70.30. There's a lot of, I've read a lot of recent bank analysis from like Goldman and Citi and Barclays, and I'm telling you, the macro side, more the fundamental side is, you know, these banks are starting to turn a little bit more bearish on the Aussie. So that's something to note. It's, you know, more to do with like the current account and trade moving forward. But it's just something to note. I'm not selling Aussies as a result. I'm just, you know, making note of it. So for right now, I'm going to keep it on range. I do want to keep it on. I do want to put it on bearish, but I'm just going to stay away from that for right now. The Kiwi, on the other hand, well, I guess it's kind of the same thing, right? It's like we're still holding these supports. So 65, resistance 66, maybe 15. Keep it in range. The dollar Canadian. So with the dollar Canadian pushing, I would really like to see it below 132 for me to put it back in range. I actually believe I might have been stopped out overnight. I got stopped out right here, actually at this price, right where we're at. I got stopped out at 132.39, and I'm thinking that I might have been stopped out before a reversal. So I don't want to turn back to range yet, because I still think this inverted head and shoulder pattern can play out, especially while we're above the shoulder. So let's just watch today for 32.10. And I might flip back to range tomorrow, but I still think it's bullish here. It's just, you know, I think I told you guys yesterday, I sold some of my position soon as Donald Trump tweeted the other night when I was, oh no, I told the people in my chat room. I don't know if I told you guys. I told the people in the ForexAnalytix chat room. And I'm not sure if I told you guys yesterday. I was walking my son, or my son was at practice, and I was in the park, and I was walking around the, you know, oh no, I did tell you guys. I think I did tell you guys yesterday. Anyway, I sold at 133.30. I sold part of my position up here after, you know, basically Donald Trump wanted to go back to go back and negotiate. So when that happened, I didn't think we'd retrace this whole move, but
Blake, we have a data in about 10 seconds. Sorry to interrupt.
Oh, thank you.
Jobless claims.
Oh, just weekly unemployment claims?
Yes, sir.
All right, let's look at it.
Expecting 820K or something like that.
Yep. 820,000.
Where is it? I don't see it.
You know what? Let's see. It might be, did it pop up on,
I don't think
Flash
it's.
yet?
I don't think it's been released yet. Oh, there you go. 840 just now.
Yeah, it came out actually at the same time. So a little worse than expected.
Yes.
Dollar isn't moving at all. So that's it. All right. Thanks, Delios. All right, I'm going to wrap up here. I'll be done in a couple minutes here. So dollar Canadian, where's resistance today? I mean, resistance is back here. It's actually exactly right here, which would be that trend line, be 133.40. I doubt we see that. I mean, and I doubt we get anywhere close to that, but you never know. I've seen weirder things happen. Sure you guys have too. Dollar MEX holding through support here. That support is going to be at 21. Let's just write 21.30. Resistance 21.75. We're at a range. Here's the dollar Swiss. Now the Swiss is actually holding up pretty well, and I'm going to talk a little bit about yields and the bond market I'll chat with Steve and Stelios about that. But one of the more sensitive currencies to yields not only is the dollar yen, but could be the dollar Swiss. So keep an eye on the Swissy, especially if we can hold, this 91.40 resistance right now will be, I mean, I say all the way up here, but I mean, I'll write down 92.50, but 91.40 and 92.50. I think you got to start looking at it a little bit more carefully, because it might be more yield sensitive. And we are seeing a move in yields. Okay, so just keep that in mind. US dollar to Norwegian krona, I picked up a little bit today. Inverted head and shoulder pattern developing here, but really key support is 920. $940. Oops. Remember, this is bullish. Just as a refresher memory. Broken long-term trend lines. Tested the 200-day, pulled back to support. Might have a longer-term inverted head and shoulder pattern on top of this little mini head and shoulder pattern developing right now. So just, keep an eye on that. Dollar yen. Actually, you know what? I'm going to save dollar yen for last. Let's go to dollar index. Here's the dollar index. I'm still bullish while we have this inverted head and shoulder pattern. The dollar Canadian may have, stopped me out, but it hasn't. But look at the dollar index, which isn't really reflecting the dollar Canadian so much. So we're still holding up. This is the inverted head and shoulder pattern neckline, still holding. That 50% retracement is key. It's the same numbers as yesterday, which is 94 and 93 and a quarter. But there's 93.25, 94. It's going to be really hard. Let me say this really quick. It's going to be really hard for the dollar to sell off with yields rallying. I know yields are down slightly today, but I'm gonna go to the dollar yen here in a second.
Great point.
Yeah, I mean it is right.
Unless bonds are rising at a faster rate, which I'm not sure because I don't follow them. So that was happening earlier in the year.
Yeah, but I'm going to show you something real quick. So let me just do let me do
Sure.
gold.
See, I tell you, I interrupt you all the time.
You know,
that's why I walk away because I can't control myself.
1915. And support is 1880. I think our numbers have stayed the same there. All right, so let's talk about the dollar yen. Actually, you know what? Let's go over to the bond market. Let's go to the 10-year. Okay. Now, that's a big, think about this consolidation, think about where we've been, and think about how long we've been consolidating here. Okay. We're now below the 24% retracement. And in my opinion, coming out of this long-term consolidation, there's more to come. So that's the bond market. So that means yields are going up, right? So here's yields.
Yeah.
Yields are starting to break higher. Now we have some distance to go before we get to the 200-day moving average. I actually talked to my mortgage guy. You know, I'm not a person that will refinance my house all the time. I just happen to, most of you guys knew I had moved my residence first time in years. I moved like 2 years ago. For the family to get us closer to the school and, multitude of reasons, but it was only like a mile or two away from where I lived previously. So for me to refinance already on my loan, it's like, okay, no harm's done because, it's like it was a big difference in.
It lowered your payment.
Yeah, I mean, it's more of, I don't think about that. I think about what I'm paying the bank longer term.
Yeah.
And so my rates were significantly less in 2 years' time. So I was like, okay, I have to take advantage of that. And I was talking to my mortgage guy yesterday, and he's like, yeah, that might have been it for yields. He goes, I don't think he goes, rates might be. That you might have nailed that bottom. And he's just talking like, he talks more longer term, and he's he's a guy that's been in the business for 20 some years. And
will you ask him a question, Blake? Because I'm hearing that mortgage companies and banks are being much more strict about, refinancing is fine, but cash out refis.
Oh, they don't do that.
They won't do that anymore?
They do, but it's really hard to do that. We actually had this conversation.
It didn't used to be. People used to use their house for an ATM.
Yeah, but I was asking them, like, based on home values going up so aggressively, not only in my neck of the woods, but everywhere. I'm like, how many people are taking cash out of their mortgages? And he's like, people are trying, but banks are very, there's a lot of stipulations to do that. So they don't
want the exposure is what I'm thinking.
No, because I whatever the reason why, banks are.
So the only way you capture your profit is that you're going to force people to sell to capture a capital gain.
Yeah, something like that, I guess.
Yeah, it's weird. But it's never been like this.
I did ask about that just because I was curious, like I said.
All right, so it's true.
Yeah.
Okay.
Yeah, it is.
All right.
Yeah. Okay, let me just compare this really quick. Okay. So if you see the dollar yen, and just look, the last time we spiked up at these levels were in June. The dollar yen was at 109.50.
Yeah.
Now, am I expecting the 109, dollar yen to go back to 109.50? No, not necessarily. But do I think the risk for the dollar yen to move up towards 107 exists, with yields possibly going to break this 38% retracement and go back to the 200-day moving average, back up to 90? And maybe if things really get crazy, could we go even further than that? Yes. Yes. So, you know, and I try to think back, you know, pre-pandemic, the dollar yen was trading at 110. And I remember where it, like the dynamics of the dollar yen really changed right here at the very end of the year or beginning of the year when we moved back above 111. The dynamics of the dollar yen, just the way it traded and the correlations changed right after that. And then obviously the pandemic hit. So the dollar yen hasn't acted the same since, but it has been sensitive to yields, not so much to risk appetite or risk aversion as much. And
not
much
gold as much as it
gold
used to
as
be.
much. No, it's almost an inverse now. So yields still seem to matter when you're talking about the dollar yen. So just keep an eye on it, especially if yields start to break out, is the point I wanted to make. Now, let's talk about the bond move with Steve and Stelios. Good morning, guys. How are you doing?
Good morning.
Good morning.
Shoot,
Morning.
I'm gonna do this really quick.
You know, we were chatting about bonds on our Skype group, and people who have been listening know that I've been short 10-year bonds for a while now. It's gone nowhere, but I've also shorted via an ETF. I've shorted treasuries as well. That was a couple of days ago, and I think personally, the more issuance we get from the US, even though they're buying a lot of it themselves, the more issuance we get, the more yields will have to eventually go up. Because at the end of the day, when the dollar is losing value, you can't keep issuing 10-year debt and asking to pay only, 1%, 80
You
basis
can.
points, 90 basis points. You
You
can.
can, as long as the Federal Reserve buys it all.
Well, that then defeats the purpose of issuing debt, right?
Yes.
Because somebody has to buy something that you issue, otherwise it's going from one pocket to the other. And how do you fund your deficits? That's the thing. So I think, remember, Coach, you asked me earlier this year, quite early, was February, March, so yields were like 130, 140. You said, because I said I'm going to be shorting bonds, and you said, are you going to be shorting treasuries? I said, no, I think we can get a lot closer to zero. I don't think we're going to get to zero, but I think well below 1%. And, here we are. So,
So you're shorting boons.
I did short bonds some months ago, and they've been pretty flat.
Okay.
So I'm waiting for that.
I think TBT goes about 18 or so for first stop still.
Yeah, that's
And
the one
then
I have.
maybe
And that's
maybe 23 if things get really going.
That's twice leverage as well, that ETF. So it's a little bit more risky, but I like it. I want to start building a position in that.
He likes it.
So Steve, where do you sit on the move on bonds? Yeah, now that we're seeing like the 30, here's the 30-year, just to give you guys a different view of a different part of the curve. There's the 30-year. Here's the 10-year. How do you feel about the bond market and what's going to happen here?
I don't have any real feelings about the bond market because I don't trust it as a market anymore.
Yeah.
So I know it sounds, it sounds like a very simplistic answer, but I have no reason to consider it a market anymore, to draw any conclusions. I do believe that on occasion it's going to seize and yields will want to spike a lot higher, but I still don't see any reason why the Fed will hesitate to buy all of it if needed. So given that, I'd rather, do other stuff.
Got it. Okay. All right. Well, with that being said, I'm going to pass it over to you guys, and then you guys can debate it all out. So,
thanks, Blake.
Thanks, guys. Have a good one.
All right.
I'll talk to you soon.
Thank you, mate.
Steve, you know what I could say about that? Feelings, nothing more but feelings. You don't want to trade it because the Fed took it away from us.
Yes.
By the way, speaking of that, the situation with the bonds is not that dire. So I have to tell you that I really like the confluence of supports we're testing here. It looks to me like bonds could really continue lower within the context of this broader channel, meaning, even down to 167.50.
Wait.
So
yeah,
Steve, I'm sorry. I was about ready to log out, but I got to ask you this question. If you don't believe in the
U.S.
bond
Treasury
market,
market.
U.S. Treasury market, how do you believe in bonds and other
because comparing the Germans' point of view having to do with market interference and the Americans' point of view having to do with market interference is like comparing, a teenage girl to like a 50-year-old woman.
That makes no sense to me, but okay.
Got it. Okay. I'll let you go from there.
Feelings. All right.
Let's not elaborate on that comparison. Okay.
Yeah,
Yes.
I mean, tell Draghi that he, I mean, he didn't do much.
Yeah, Draghi.
but-
Listen. First of all, Lagarde is definitely a step forward in the wrong direction for the ECB. There's no question about it. She's a lot more dovish, and I'm pretty sure because her main, her
background.
her background, first of all, she's in essence a politician. Okay, she's a fixer and a politician. That's what she is. So I have no doubt that Lagarde is totally willing to take it all the way and do all the wrong things at whatever extent is needed. Now, there is a differentiation here that
Anthony wants to know which one is the 15-year-old, the USA or EU?
I want to ask, is he the famous Anthony Kanakis or somebody else?
Really? We have an Anthony
There's
Kanakis
a guy
here.
on TV. Yeah, the comedian.
Yeah.
Anyway. All right.
Maybe it is him. He made it.
Okay,
yeah.
so in any case, I do think that the bonds, in a limited way, of course, as all bonds, can move more freely, and I do think within the context of this larger channel scenario that there is a much better likelihood that they can actually move to the downside. So German yields to the upside. Now, having said that, do I believe that bonds are actually going to end up like breaking down and depreciating like vastly? No, I don't think so, and I don't think so for two reasons. First of all, as all government bonds that are considered like safe havens, they will remain, of course, manipulated at an extent. Second of all, let's be honest, between treasuries and the bonds, which of the two would you actually hold as a risk-free asset?
Well, they're both risk-free, but one you have to pay away to hold them. They are risk-free. Nobody's going to default, right? Nobody's defaulting. The US will not default.
Nobody's going to default is a valid explanation if we take out of the equation the FX risk. And unless you are an American, that anyhow your income and your assets are in dollars, that's not the case about treasuries. Personally, the idea that I would be repaid back in 10 years my money in US dollars makes me have cold sweat.
Yeah, true.
Personally.
True. Yeah.
If you told me that you have to keep your money in promises to be paid dollars in 10 years from now, I would probably lose a lot of sleep at night. A lot of it.
Yep.
But,
on the
that's
other
my
hand,
point of view.
Oh, hold on. I'll be back.
Okay. So in any case, Dale, anything else before we go to the questions or whatever?
Sorry, Steve, I'm back. I have a couple of things to say before I shoot off.
Yes,
Actually.
absolutely.
We had a few things from Trump and from the UK. So we saw yesterday's debate on the vice presidents, the VP candidates. Nothing really changed apart from the fly, which was interesting. But the suggestion now is that the following debates are going to be virtual debates between the Trump and Pence, Trump and come on, I forgot his name now.
Biden.
Oh, God, Jesus. But yeah, so there's going to be a virtual debate, but Trump says he will not attend it. So that's going to be interesting. Trump is actually also changing his the way he's speaking. He's saying that stimulus talks are starting to be productive, and that there is a really good chance to reach a deal. The talks have reopened. So you get one thing one day, you get the other the next day. So that's why people have to be very careful about tape bombs. We said this yesterday, and it's just going to continue. He actually also said he's planning to use tariffs on China in the second term. So he's confident about that. And
if you remember, Stelio, many weeks ago, I said that be careful being short, because ahead of the elections, they're going to throw every rumor, every stupid, speculation about positive things happening. And, now they're just throwing everything at it. I mean,
yes,
it's to be expected.
Yep. Yep. And the other thing we had was Boris Johnson, his spokesman, said that Johnson thinks that there is a Brexit deal to be done, but time is almost up and they're prepared to end without a deal. It's the same thing that he's been saying for a while. Bank of England, also, they made some comments. Andrew Bailey, the chairman, he said that the main view of the Bank of England is that there will be a deal. I think he said there's a 2 in 3 chance that there will be a deal, and that both sides have vested interest to actually make a deal. And you guys know I agree with that. Obviously, the question is, will we get it? But a lot of headlines coming out of the UK and the US, and just trying to keep you updated with all that. Although nothing really new has been said, and that's pretty much it, actually.
Yeah, I'm really not looking forward to the continuation of the saga, but I guess we'll have to live through that as well.
Yeah. Imagine if Trump gets re-elected and we get 4 more years of China-US trade wars and all this. That's going to be fun.
Yeah, at least something. At least even if he gets re-elected, I think that there is going to be no reason to have all this charade about the deal, because once he gets re-elected, he doesn't really have any reason to try to sell.
First couple of years are going to be relatively quiet, right?
Yeah, and he'll really have no reason to try to sell like a deal as something good or whatever, because what is it for him? So at least we're going to get a more honest approach to whatever's going to happen between the US and China, and not try to fool everybody that supposedly things are moving in the right direction, when in all actuality nothing has really happened. Okay, cool.
Somebody's asking for Aussie yen. I'll let you do the crosses or whatever you need.
Sure, absolutely. Okay. Dollar, by the way, just a fast comment here, because I almost always start from here. The dollar index still testing this ascending channel trend line support. As I've said before, if we break through it, I would be very, very careful. I think we can easily see a move towards and even a little bit below 91. So, very, very key area of support here. Yeah, you want to be long, this is the place to do it, but we break through that, I think it's not a good idea anymore. Indices testing the 61.8. Personally, I've said it before, there is absolutely no way I would be short ahead of the elections. I'm not saying the index cannot move and the indices cannot move lower ahead of the elections, but what I'm saying is that now we've entered a period of time that in essence you will be fighting both the Fed and the government. And personally, I have absolutely no intention to go into this. I bought it the other day and made almost 70 handles. I'd be more than happy to buy it again, but there's no way I'm shorting indices until the elections are over. My personal point of view now, I'm just giving, the picture the way I see it. Doesn't mean that I'm right. I've been wrong many times, but what I know is that I would definitely not be short. As simple as that. Somebody asked about natural gas. I still see the potential here of a bull flag. And as I've said, we break through this bull flag, most probably we're breaking through to 90. And if we break through to 90, I think we're headed much, much higher in natural gas. Crude oil seems to be breaking out of this symmetrical triangle. Of course, it's early on the day. At the very least, I would want to see a daily close. So, take that with a pinch of salt. At the same time, we're testing this descending trend line resistance in the RSI as well. So I think if we get a breakout here, it's going to be a breakout both in the price and the RSI. I wouldn't want to go against that either. That would also potentially point to more strength. I mean, you know, there is a decent correlation between stocks and crude oil. So I think that, you know, both of them continuing to the upside for the time being is the path of least resistance is the likeliest scenario. As you saw a few days ago, a couple of days ago, when was it? Once Trump saw the reaction, the market reaction, and of course, the expected continuation that we would have of taking the punch bowl away from the party, meaning take the stimulus, because, you know, they might try to say a lot of things, they might try to convince you about a lot of things, but I'm very sorry to say that if you really believe that the economy is doing okay and the economy is recovering, and it's not only based on exorbitant amounts of stimulus, then you really don't understand how the economy works. I mean, I even see headlines saying that initial jobless claims, you know, are looking better, which they are, but people don't realize that initial jobless claims are like 5 times up to where they were considered to be normal. So we're talking about a market that's rallying to new highs or is very near the all-time highs, and at the same time we have 5 times the unemployed people on a weekly, on a monthly basis. We have huge unemployment, and I'm not talking about the 7.8%, which is, of course, you know, distorted by the completely problematic way in which the unemployment is being counted.
What do you think it really is, Steve? I know it's just your
let's
opinion.
take it opposite, and you know that my comments are not political because I have no problem shooting in both directions.
Yeah, I know.
Trump pre-elections used to call unemployment fake because of the way it's being counted. He claimed that real unemployment was 20%,
20%, yeah,
25%, 30%. His words, not my words. My words. Question: has the way we count unemployment changed since he was elected?
No.
Answer: no, it hasn't changed at all. So, having kept the same methodology of measuring unemployment, can he be in both cases right? I mean, can the unemployment be good pre-COVID and at the same time being fake just because it was 1.5% higher during Barack Obama's days? No, it can't. Now, the truth is the following. If you saw the other day, we got another drop in unemployment. Why? Because labor participation keeps dropping. So we have a lot of people that are discouraged and they just leave the workforce completely. Now, are these people actually not unemployed? Answer: of course they're unemployed. They want to have a work.
They don't count them. They don't count them.
They do count them, but with the changes they've made pre-Obama, pre-Trump, of course, it was in the 90s, these people are now being counted not in the main unemployment number that's been in the spotlight, which is the U3, but in the U6. Okay. I've said it before, just to put things in context, a few decades ago, the main unemployment number was not counting just what U6 counts today, but even more than that. So in essence, nowadays, we count people that work part-time, even if they have like a menial job that they work like 5 hours per week, we count them as not being unemployed. We used to count those people as being unemployed because they're looking for a full-time job and what they have is a few hours just to make ends meet. Yeah. Nowadays, we count those people as employed. Not only that, if you have 2 or 3 jobs of, let's say, 5-10 hours per week, each of them,
It's
each
three.
of, yeah, it's 3
They
jobs.
count it as 3.
Yeah. So
Wow.
the same person that we used to count as unemployed a few decades ago, we now count him as 3 workers in essence. So,
Yeah.
you know, second of
Yeah.
all, people that had dropped out, that had been unemployed for more than a year, we used to count them as unemployed, of course. Nowadays, they don't count at all. Once 365 days have passed and you're unemployed, that's it. You vanish from the index, the U3 index.
Huh.
So, you know, now you go figure if unemployment is 7.8%. Of course it isn't. I mean, what would I guess? I'd guess 15%.
Okay.
Conservatively.
Right.
15%. I remind you that Trump himself, when the nominal unemployment was 5%, he thought it was 25%. So
Right.
I'm a lot more conservative in my estimations, okay?
Thank you, Professor. Steve knows his stuff. All right. And you know what? We have another guy who knows his stuff coming on right now, Peter Bookvar. So Peter's here today, Steve. If you're through.
We have Peter. That is actually great. It's
Yeah.
nice to get Peter's
let's see what Peter, who I know is, you know, looking for inflation or reflation because of supply chain issues and looking for a weaker dollar,
we've
etc.
had interesting conversations on the summit about inflation
Hi.
rate and how inflation in essence is different for people, you know, that have you know, a lot of wealth and people that are actually, you know, striving to make ends meet, and you know, it makes sense.
You guys-
Hi,
And,
Peter.
hey Peter.
hey, how are you?
Pete. Welcome
Good.
back.
How have you been?
Thank you.
Okay, so I'm going to be showing the charts, Peter. How are you? And
Good,
do you
thanks.
mind
How are you?
do you mind if we start with yields, buddy?
Yeah, let's go ahead.
All right, so you know, here's the move in yields that we had here, and I know, you know, Paul has been saying, not thinking about. So why are rates grinding up and starting to become sticky? And you look at some longer term charts, it almost looks like they're threatening to come out of a base here, and you know that we could head up towards 120 if this technical pattern is valid. What's behind it?
Well, I think it's the market sort of reasserting some opinions on the state of things from the Fed. I think what's even more noteworthy than the rise in the 10-year is the rise in the 30-year yield. And I bring up the 30-year because the 30-year is the least influenced by Fed policy because it's the furthest out on the curve. So I think we've seen a rise in inflation expectations. 10-year break-evens are at the highest levels. We're near the highest levels in a while. You have commodity prices that, you know, outside of crude oil have been trending higher. The CRB food index is at the highest level since or near the highest level since mid 2019. You've had industrial metals that have been trending higher. Obviously, you have good performance in gold and silver. You have the hopes on all this fiscal spending, which, you know, regardless of how productive you think it'll be spent, it's still another $1 trillion plus on top of $3 trillion that's been already spent. There's an enormous amount of issuance, and I think
so. The bond vigilantes have been reincarnated in this era. Do you think?
You know, I think that they're slowly beginning to perk their heads up. And also you've had some decent news with some of the antivirals. I mean, if you believe that COVID is not forever with us, I think that over the next couple of months, we may continue to get some good news on that front. We could get, you know, we're going to get the phase 3 trials from Pfizer at the end of October, early November. And while I think that there will be some side effects that they'll talk about, I think overall it could be some good news. And I think, you know, the day you get good news on a vaccine, I find it hard to believe that the 10-year yield is still going to be this low. So I think you combine that all, and I expect higher inflation. I expect higher, longer-term rates. And I don't think the market is even in the ballpark in thinking that.
Yeah, so I mean, there could be some reassessment, especially if they double from here and say we go to 130 on the 10-year. And I want to get to that, what effects you think it's going to have on the markets. But I also wanted to ask you this. So, you know, here, I mean, TLT is a proxy for sovereigns, right? And you see we're threatening, and, you know, the bond market threatening a breakdown, or already has. My question is, why are sovereigns weaker than high yield? And why are they weaker than corporates?
Well, I think corporates are still getting a bid because they think that a big fiscal government spending plan is going to, you know, save these corporations, and another 25 billion plus to the airline industry is going to, you know, save the airline bondholders. So I think that is, at least for now, one of the reasons why corporate credit has traded the way it has relative to treasury yields.
Because I know you and I were trained that the flight to quality is in treasuries, not corporates, not high yielders, and we have a weaker structure. Has the Fed, in a way, sacrificed sovereign debt to support these other two markets?
No, I think they're trying to save everything. I mean, essentially, Fed policy right now is just monetizing the U.S. Treasury. And
Okay.
there's nothing stimulative in what the Fed is doing. Having rates at zero hurts small and medium-sized regional banks because it squeezes their profit margins on loans. If you squeeze the earnings capability and the loan margins for small and medium-sized banks, that means they lend less money to small and medium-sized businesses that don't have access to the capital markets. So I argue that Fed policy is restricting growth. It is not contributing to it. And therefore, the only purpose of what Fed policy is to monetize the treasury market, lift asset prices, including corporate bonds, and hope that stock prices go up. That's all that monetary policy is doing right now.
Okay.
Peter,
All right.
a pessimistic counter argument having to do with that is that the same banks you're talking about, and first of all, I agree 100% with what you said, but the counter argument is that the balance sheet of the banks is such and has is heavy on stuff that if yields actually move higher, it's going to implode, because in essence, a lot of what they hold in their balance sheet is not going to survive higher yields.
Well, yes, I agree. But based on that argument, that means if you're talking about Europe, that means rates will stay negative forever. I mean, at some point, rates have to go back to at least zero in Europe.
Exactly. That's why I agree with you.
So,
I think they've painted themselves in a corner, and there is no good way out of it.
Well, that's clear. I mean, the ECB, if we want to shift to them, they're not just going to be able to just raise rates back to zero. It's going to have to be part of an agreement with the entire Eurozone that if they need to recapitalize banks, then they're going to have to do that at the same time, or they'll have to waive mark-to-market rules on their massive holdings of European sovereign paper. So there will be hand-in-glove discussions going on when the time comes when the ECB wants to get out of negative interest rates.
Agreed.
Okay, so Peter, if we're going to have a rise in yields, is that eventually going to compress and make valuations look even more expensive than they are?
At some point, yes. I mean, I'm sure the initial reaction, we've seen it this week with the rally in the stock market, that the initial reaction on
it's good. It's good news.
Well, it's good news. Rates are rising for the right reason, blah, blah, blah. You know, I've heard that movie many times in many cycles over the last 30 plus years. And then you reach a point where that rise in rates starts to matter in terms of its impact
Like 87, we
on
had
asset prices.
disintermediation. Yeah.
Exactly. And people have to look at the rate of change in rates, not the absolute level in rates, because I'm sure there'll be people out there and say, and even if the 10-year went to 1.5, oh, it's still very low. It's no big deal. Even though a 1.5 rate, if we were to get there, would be more than a doubling or actually a tripling from the lows. So I think people need to focus more on rate of change, especially when you're paying high multiples for stocks, and especially when you're trading at 2021 times 2021 earnings, and we're not even done with 2020.
Okay, so that stocks, how about, they talk about one of the, and I'm still bullish long term, but I'm looking at the gold chart, and silver has even been weaker than gold on the gold silver ratio the last few months. If yields head up, doesn't that create more opportunity costs for the precious metals for a while, and they could be under pressure?
Only if the inflation numbers don't rise as well. As I am of the belief that we are going to see further increases in the inflation statistics, I think the inflation numbers will rise coincident with or even more than the rise in market rates. So that's why I think real rates still have room to fall, and it'll be real rates that the gold and silver market focuses on more so than the nominal rate market.
Okay, and the dollar, Peter, I mean, it's trying to make a stand here. Here's your daily, we've had a little reflex rally. I bet, being a mind reader, you'd be a willing seller of the dollar on any further strength up between here and here on Dixie. Am I correct that, is there a place where dollar bears are going to have to say it's not going to happen for a while?
I mean, the dollar rally really happened only on days when the market didn't think to be a stimulus package. So we're at a point where the dollar is rallying because there's bad news, not because there's this positive backdrop to the fundamental story with the dollar. I mean, we had a near record trade deficit this week. Yeah. We have current account deficits that continue to widen. We have budget deficits that are exploding. There's no long-term bull case for the dollar that makes any sense to me.
Even yields going up?
The bull case for the dollar is really just on short-term factors, and like if things hit the fan or there's this dollar shortage that I've been hearing about forever.
Yeah.
That,
but you don't buy into that all these emerging market economies that have their debt based in dollars, that creates a shortage in dollars to service their debt and roll it over, et cetera.
Well, the one offset to that is that a lot of these countries that have companies that have these dollar-denominated debts, and even the countries that have dollar-denominated debts, they also have a higher percentage of dollar reserves than they've had before. So we need to look at both sides of the balance sheet when analyzing these dollar liabilities. We have to look at the dollar assets as well, and I think it's more balanced than people make it out to seem.
Okay, and any reason why? Go
plus
ahead.
That foreigners still own about a third of the U.S. Treasury market. So if they needed to sell U.S. Treasuries to get dollars, that's something that they can do, and it's certainly something they did pretty aggressively last March.
Okay, this recent pop in rates has supported banks, the XLF, and I think, what is it, KRE for the regionals, Peter?
Yeah.
So that's going to be, if we're right about higher yields, that's going to be so supportive for that group. I just wanted to, ask you why you think, and this rotation that's going on, it seems like they're selling, the high flyers. I've asked a few people that could it be that they're prepping for higher capital gain taxes on a Biden victory, and they have such outsized gains in things like Amazon and Apple and Google and all of them, that they're booking those and rotating into things that really haven't participated, like the transports are on the verge after 2 years of finally making a new high. What's your comment on the rotation? Do you think it's something that's going to stick for a while? Because when I look at some of these issues here, Peter, I don't think Amazon's going to make a new high before we see it take some more air taken out. And you look at something like Google, look at this on the daily, the only thing it's holding, and it's been a pretty weak bounce, and I think, you know, we could even bounce a little bit more, but it's threatening a pretty important breakdown that could take it down to, you know, 1200, 1100. What do you think is behind this? Could it be people would rather take capital gains now at the current rate and not wait until the presidential election to do so? Could
I mean,
that be
I
part of
think,
it?
yeah, I mean, I think that that's definitely a factor, but I think that decision won't be made in earnest until after we see the results of that election. Because if Trump
Isn't
wins,
that one of the silliest reasons to make a decision in the markets?
well,
Tax
yeah,
consequences.
but keep in mind though that if Trump wins, that person will be saying, "Well, why did I sell? I could have just held on and not have to pay that tax, even though
Yeah.
it would have been a lower." So, to
Well,
me, the election is a lot more of a coin toss than the polls make it out to seem. So,
okay.
while yeah, maybe some people want to start trimming going into the election because they don't want to be forced to sell the day after if everyone else is doing the same. But on the other hand, Trump wins, then you know there could be some regret. I think at least right now, because we still have a month to the election, or almost a month, and in politics that seems like an eternity.
A lifetime. Yeah.
That you know, I think that the steepening yield curve is resulting in obviously a shift into the banks that could actually get a breather from
Right.
that if it were to continue. I think the rise in rates, to the point about maybe shifting the mania for growth, high value growth stocks, into forcing people to start looking at cheaper
Materials.
things they haven't paid attention to in years. Exactly, materials, coincident with what I said earlier about
Right.
the bounce in the CRB index. You know, those are the type of things that I think maybe the market's looking at. And you look at the fiscal spending again. I mean, Washington's going to spend. They've already spent $3 trillion. They want to spend another $1 to $2 trillion. That you know, this is inflationary tinder, and you're already beginning to see it in the stats. We're going to see CPI next week. I think the rent component will be the only thing of note that is muted, because of obviously we see what's going on with rents. But I think goods prices are accelerating here, and I think we're looking at a stagflationary type of environment next year. And I think we're maybe beginning to see the early market responses to that.
What do you think the market response is going to be, Peter, if we don't have an outcome and it's contested and it drags on for weeks and weeks? How do you think the markets can just treat everything as business as usual in that circumstance?
I think the market will be highly aggravated by that scenario, but I still think there's the belief that once you get past the next 2 to 3 weeks, or even a month, that you'll still have a winner, and that come January 20th, you will have a winner, regardless of who it is. So it's going to be extremely aggravating. It'll be embarrassing. But a lot of it will have to do with who takes the Senate. I think if the Republicans keep the Senate, then I think there'll be less aggravation as to the ultimate result.
I never realized until this administration how powerful the Senate was compared to other branches of government. They've kind of run the show. Doesn't McConnell kind of remind you of a Jim Baker type or a Dick Cheney type, where it's really not the president running the show, it's someone else?
Well, I think that I mean, I think that is a good point, but I think the markets, at least, they just want to see a split Congress. Yeah. Whether it's Republicans having the Senate or having the House, they at least want to see a split if Biden wins. And you know, Biden, who said he wants to raise taxes by $4 trillion, I think there needs to be a party in Washington that is opposite him, so he doesn't raise taxes by $4 trillion.
Okay. Any view on what's happening in China? You know, I actually have read articles that they have this new thing, clean plate philosophy. They're not giving people as much food to eat daily. It's kind of like a soft famine where they're just not giving people the same amount of food to eat. What do you think is happening there in China? I know that you think Asia and a lot of emerging economies are the place to be. Any updates on any of those areas that have, garnered your attention?
Well, the most interesting thing about China is that the economy is pretty much back open. Movie theaters are 90% back to where they were. Domestic air travel, I think, is basically at where it was pre the Wuhan shutdown. So the Chinese economy, in terms of its reopening, is essentially back. Now, the economy is not back because there's a lot of damage that has been done, but they feel like the virus is essentially gone. It's in the past, and I think we're seeing the entire region that has dealt with this so much better than Europe and the U.S. And they're now seeing the benefits of that, and that their economies didn't suffer the same sort of downturn and are going to see a quicker rebound. So I think I'm hoping that we can use China as a model that when people are comfortable here with vaccines and antivirals, that we can go back to having 100% capacity in movie theaters and football games and restaurants, pretty much as they do right now.
What's your best guess, Peter? Back half of 21 or before that, when we could be close to the way Chinese are living right now?
I mean, I'm hoping late spring. I mean, hoping by July 1st, there are going to be concerts again. I think by then, not only will we have effective antivirals and hopefully vaccines, but we'll have rapid testing that, you'll get tested and you'll get a response within 15 minutes. I mean, that in itself can change things. Yeah, you got to show up to the sporting event 15 minutes early, or you got to show up to the restaurant 15 minutes early, or the airport 15 minutes early. But if you can do that, get tested in something that's highly accurate, because it still needs to improve its accuracy, and then get on a plane and move into a restaurant or movie theater, and knowing that everyone you're sitting next to has tested negative, I think that's going to be really helpful. So I'm hoping that late spring and early summer is when we get to that. So it's still going to be a rough sled from here to there. We got to get through the winter, and that's not going to be easy.
No, it is not, is it?
This is a generational traumatic experience that it's going to take years to recover from. But at least for the beaten down areas of the economy, like the local restaurant and, like I said, movie theater or stadium, I do think that hopefully within the next 6 months that gets better. Now, unfortunately, we're going to lose a lot of businesses in between, and that's where the pain comes. But hopefully, we're closer to the end of this than anything.
Well, I'd like to take this opportunity to invite you to my concert at the Coyote Bar and Grill next spring. I know I'm not Eddie Van Halen, but I do a decent Elvis, Peter.
That would be great if we were able to pack that place.
So, I want to thank you again for, being a regular in our community, and you did a great job in the Trader Summit, and I appreciate you and your work, and encourage people to hit the subscribe button here for the book report by Peter Bookvar. And when you're feeling like you don't know what's going on, Peter will give you a dose of sanity, and really hope that you have a great fall season, and we'll get back together maybe in December and see how things are progressing through this kind of difficult winters that we're all facing. Peter, thank you very much for being here.
Thank you, guys. I always appreciate being on.
All right, buddy.
All right,
Peter Bookvar, and you can find him at pbookvar on Twitter, and book report, BOOCK report.com. And that'll be a wrap, everyone. Have a great rest of the day, and we'll see you tomorrow, TGIF. Thanks again, buddy.